Okay, at Dealonomy, we're trying to make it as easy as possible to buy a great business. And we have some really unique things on our website that help make it easy for you, the buyer. Today, I'm going to talk about the future earnings calculator, which is in every deal room on our site. I want you to look at this every time right before you make an offer, just to make sure that you've structured a deal in a way that makes sense and is going to give you the returns you want. And it's really fun to play with. And we put some real effort into putting this together in a useful way for you and including it in every deal room. And so I just want to show it to you on a real deal. This is live on the site right now. So this is a junk removal business in North Carolina. This is set up with actual numbers from the deal. So you notice there's a line at 400,000 across the top here. That's the seller's discretionary earnings of the junk removal company. So that's the total amount of potential cash flow available on this business that you could service debt with or pay yourself with if you're taking the owner's spot, or if you're hiring a GM, you have to pay them out of that SDE number. We have a company here that's making 1.1 million of revenue. It's making about 400,000 of SDE earnings. And we have it's just pre-populated here with a hypothetical purchase price of $1.189 million with a down payment of $129. And again, if you're a buyer, you do have to pay a success fee to Dealonomy, so that's calculated into your deal cost. And then you also have other closing costs like legal fees or quality of earnings fees. You can play with that number here. You can change your interest rate. You can change your length of loan. And then that gives you your purchase price plus your fees, tell you your total project cost. And then the loan amount here is basically the total project cost minus your down payment. And if you scroll down, you can also see these other fields of growth rate, annual growth, which we have always set at 0%. So this is just showing like flat 10 years, everything's going to stay exactly the same. Obviously in the real world, you're going to grow or shrink, or, every year it's going to be a little different, but we let you play with that as the user here. So this salary needed to replace seller field, it just means, what do you need to pull out of this business personally as a salary at minimum? So some of you are going to have a working spouse that you can live off of their income, and you don't need to pull any out of the business. So you can make this a 0. And I'm going to be playing with this as we go. So let's make this 0. And then some of you, you might say, I need to make 150,000 out of this business. And then some of you might say, I just need 80,000. But as you see, as I change these numbers, the debt service coverage ratio changes because it takes into account the money available to service the debt after you pay yourself the salary you need to replace the seller. And what we really want to see is a debt service coverage ratio, ideally at 1.5 or higher. That just means you've got about a 50% fudge factor there, a margin of error, to be able to make sure you service the debt and still have a good service the debt, pay yourself, and still have money left over for profit, reinvestment, and just have a margin of safety there. If you have a less than 1 on your debt service coverage ratio, that means you're signing up to lose money. So you're immediately going to be losing money. We have this color coded, I believe, where when it's under a certain amount. So let's do a $300,000 salary. Yeah, when it's under 1, it goes red. 1.2 is about the SBA minimum that anyone will bank your deal at if you're trying to get an SBA loan. But we want to do a little bit better than minimum typically. So we want to see that being more like a 1.5. So if you're taking a $100,000 salary out of this business in North Carolina, you're still good. You got a 1.78. And then this field down here, this table, it actually shows you over time all these numbers for the coming future years and what your ROI is on your cash investment. I really like this. I'm going to explain this. So this is revenue, discretionary earnings, how much you're paying on your debt. So we show a 10-year note gets paid off, and then year 11 it's $0, and then you end up getting all $400,000 available to you, the owner, after that debt of 165 is retired here. And then this accumulated earnings is just what are you paying yourself plus what the profit is of the company adding up over time, and how much wealth are you able to accumulate by buying this business over time. All really fun stuff. It's all visually represented here in this table, in this graph. One of the things I want to show you is this growth rate. This is a huge difference. So let's say I don't want to grow at 0%. I think I can grow this at least 5% per year. You see that top line and how it just starts going up, up, and up. So your debt is staying the same down here, and your top line, your discretionary earnings is growing. And now your accumulated earnings, as you project out into the future, instead of it being what, 3 million like it was, you're now at 6 million. So that's the power of compounding of a even just a 5% annual growth rate. But 10% looks even better, right? So if we did a 10% growth rate 10 years from now in 2035, we're making over $1 million profit a year when originally it was making 400,000 a year. So this just kind of shows you how powerful, buying a business can be. I also like to play with the growth rate as a negative thing too. I like to ask myself, how bad could I screw this up and still be able to pay myself and still be able to make the debt payments, And so what I like to look at is start playing with negative numbers. So let's start with negative 5%. Okay. Watch that top line and how it starts to approach the debt payment. So this bottom line here, this dark blue line, is the $165,000 of annual SBA debt that you signed up for when you bought the business under this deal structure. And your nightmare scenario, right, is the business can't pay its debt payments, and you've got to come out of pocket out of your own savings or assets, or potentially even go bankrupt if you can't make that payment. So what would be your compound negative growth rate to actually wreck this thing? Ooh, 10% almost got us there. This line almost intersected, but you still cleared it. So you could go down 10% every year, and in 2033 you're at you're just squeaking by. You're only doing 473,000 in revenue when you started at 1.1 million. So you've really screwed this business up at this point, but you're still making your debt payment barely, and then it's gone, and now you're free and clear of debt, and you're still making a 6-figure income, even at a negative 10%. So let's take it just a little further. Let's do negative 13%. Bam, it all goes red. You died. You died of dysentery on the Oregon Trail. So I'm aging myself probably with that reference. But yeah, we have that little Easter egg here that the whole thing turns red if the business deal is unable to meet the debt obligations. So that's how you play with the growth rate. And I'm going to reset it just to 0% here. There's another thing I want to show you, and that we have this button here on the right that says add loan. So you can actually add, a very common deal structure is you'll ask the seller for some seller financing. So you'll want like a loan to follow the bank loan. So let's just pretend it's a 7% interest rate, and you want to give the seller a 7-year seller note, and you're just going to ask them for about 10% of the purchase price. Let's say $115,000. Now we just introduced a new line to this graph. See, so it's the SBA loan goes a couple years past the seller note, and the seller note is this orange line at the bottom. And then when that one goes away, your debt service goes down because you did have 2 loans right here. Now you only have 1. And then your SBA loan goes away a couple years later, and now you're free and clear. So you can play with that, and it'll just automatically do the math. You do a bigger seller note request, it ends up looking like this. So see, now the seller note's higher, the drop off is bigger when it goes away, but the whole time you're just making sure your debt service coverage ratio works. You want to keep it at 1.2 is absolute bare minimum, but I generally recommend making it like about a 1.5 after you pay yourself. And this just kind of shows you how far can you push the valuation to make sure that your deal's safe. How can you structure it with one loan or two or zero? And then it'll tell you everything, including your rate of return. I really like this ROI on cash invested. Like, isn't that phenomenal? What else can you put money in that gives you an 80%, first year return? Like, you can't really get that outside of the small business world. So feel free to go to Dealonomy.com, sign non-disclosure agreements, look at our deal rooms, use that future earnings calculator to structure the deal that's going to work for you, and play with that growth rate, play with your assumptions, your down payments, and make sure it's going to work. And then you can click make an offer and build a letter of intent, an LOI that you've already tested with this. And banks are going to love it too, because they're looking for that debt service coverage ratio, and they're looking for some evidence that you've thought through. How are you going to pay for the debt? How are you going to pay yourself? What's the earnings going to look like if you grow a little bit, if you shrink a little bit? And you can play with all that right on our site. We just made it super easy. You don't have to be an Excel ninja to use it. You can just plug in the blanks and it'll spit out the answers for you. So appreciate you checking this out. Make sure you play with the future earnings calculator on all our deals at Dealonomy.com.